6% plus inflation, prices going up, is not inflation under control. So is the Fed going to pause before inflation is under control? And that, of course, would be dramatically positive for gold.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 10th through January 17th, 2023, while supplies last. This week we feature the 2022 Silver Krugerrand at $3.99 over spot, and the Valcambi Silver Kilo Bar at $2.99 over spot per ounce. For years, the Krugerrand was the most known bullion coin in the world, and in 2017, the South African Mint and Rand Refinery began minting a silver counterpart to the famed gold Krugerrand. The 2022 Silver Krugerrand bear the Springbok on one side and the portrait of Paul Kruger on the other, and have a face value of 1 rand. They come 25 to a tube, 500 to a monster box, they are IRA eligible, and are renowned for recognizability and design. Best of all, they are only $3.99 over spot. Next, from Valcambi, a Swiss mint known for producing some of the highest quality products in precious metals, we have the Kilo Silver Bars, which are 32.15 troy ounces of 3/9 fine silver, cast with individual serial numbers and a beautiful antique-style finish. They are only $2.99 over spot per ounce, they come 15 to a box, and are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Adrian Day from Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Well, good afternoon, Elijah, and thank you so much for having me again.
Well, it's great to have you, and it was, again, a pleasure to meet you back in July at the Boca Raton Rules Symposium there. A lot has changed since then. It seemed like we were, in the dumps for both gold and silver, and now we're, kicking off the year with a nice rally here. What do you make of what's transpired in the last 6 months?
Yeah, there's been a huge change, not just in price, of course, but the sentiment has changed completely. I think what's been happening with gold is it's really interesting. As we know, gold acts, or to quote my friend Frank Holmes, there's the love trade, there's the fear trade. And so gold can react to both concern about everything, but also to positive news. And I think what we've seen with gold is a sort of two phases to this rally. In September, when it bottomed, October, November, I think there were a lot of institutions as well as central banks, of course, buying gold as a defensive asset. They were buying gold because nothing else was working. The stock market was looking very vulnerable and was down for the year. Bonds were down. Even the short-term 3-year bonds were down about 8%. So you're losing money on what should be safe. You're losing money in the stock market. Global markets, of course, if you're a money manager sitting there and you're down, 15% for the year in September, well, you've never been down 15% for the year before. We have in the gold space, we're used to it. But if you're a conservative money manager and you suddenly see your accounts down 15%, you're looking for some way to defend yourself. And it isn't foreign stocks, not the developed markets, and it isn't Bitcoin. So the only thing left really, the two things left are cash, which is losing money to inflation, and gold. So I think in September, October, November, you had a move. As I say, a modest move, a small move, the beginnings of a move, mostly institutions, into physical gold. Then, of course, in December, and particularly this month, we've seen that shift to the narrative. Well, the dollar's down, of course, and the narrative now, people are focusing on when is the Fed. We know the Fed's going to slow its rate of increase. And slowing your rate of increase is, of course, simply a prelude to pausing. And so people are focused on, well, when is the Fed going to have to pause? And on a more fundamental level, are they going to pause before they get inflation under control, because everyone's, yelling and, shouting hurrah about the latest CPI. But, 6% plus inflation, prices going up, is not inflation under control. So is the Fed going to pause before inflation is under control? And that, of course, would be dramatically positive for gold. So those are the two sort of phases of this move, I think.
It definitely seems like, yeah, I mean, if you heard 6.5% inflation just a few years ago, that would be incredibly high, but people are celebrating it. That's a really good point. It's not really good news at this point.
No, absolutely. And, services are still going up very strongly. Now, of course, I don't like playing the game where, every time the CPI comes out, you say, oh, but the mean adjusted core, seasonally adjusted, is good. So inflation's really under control. Or, oh, did you look at the services X transportation and apartments, housing, that's up a lot. So inflation's still roaring. I don't like playing that game, which the Fed seems to like to play. But there are some indications that for ordinary everyday households, prices going up is still a problem. And again, you look at shelter, you look at transportation, those are still up meaningfully. The Atlanta Fed has something that they call the sticky inflation index, and that's up 6.7%, which is pretty much a high for this cycle. So I don't think we can yet say by any means that inflation is under control.
And I guess it's a really tricky situation for the Fed, and it has been, because I know in your quarterly newsletter you just released at the end of December, you mentioned how there's weakness in the economy everywhere, and all signs are strongly suggesting a recession ahead. So it seems like, how can the Fed continue to raise rates, into a recession? It doesn't seem like that would be a prudent option. But the alternative then is also, you have high inflation. So it seems like the Fed is kind of trapped in this situation.
Well, it is trapped. It's trapped in a dilemma of its own making. We never seem to hear much about how the inflation is a result of the excess money that's been created over the years. We don't seem to hear too much about that. But yes, they do have a dilemma. And that's why I think they're looking, like Jerome Powell is talking about, slowing the pace, but keeping rates high for longer. And maybe that's the best option at this point, if you're trying to get inflation under control without causing too serious recession. The result, of course, of that is likely to be maybe not a deep recession, but a more long-lasting, weak, soft economy. I think nobody likes a recession, of course. So nobody wants that, because it causes pain for real people. But the best, after you've had excess, the best that can happen from a macroeconomic point of view is a short, sharp recession. Or let's say the best that can happen is a sharp recession, and sharp recessions tend to be short recessions, because you wash out all of the distortions, or you get rid of all of the excesses of the previous boom. But if you try to bring things down without causing pain, as we saw in 2008, you never wash away the excesses, particularly if you just keep on printing money cheaply. So you have, people households, companies borrowing money that they really shouldn't be borrowing because money is so cheap. And then when rates start to go up, that causes a problem. Gosh, I'm being nice to Jerome Powell today, aren't I? That's unusual. To his credit, he has said that he knows there will be pain with this policy, which he didn't hear too much about in 2007, 8. 2008. But to his credit, at least he's saying there'll be pain, but he still seems to think there can be a soft landing. I'm not quite sure how you define a soft landing, but to me, a soft landing is, you go through the whole cycle, you win your war against inflation without having a recession. And I think that's next to impossible.
No, when it comes to the stock market, I know you were mentioning how, a lot of money managers out there are probably thinking, 15% down, if that's their portfolios. That is not good for a year. What does 2023 look like for you for the general stock market? I know last time we had you on, you were talking about how even the rate hikes that the Fed has already done, the damage has not been seen yet.
No, the damage hasn't been done either. It hasn't been seen either in the economy or in the or in the stock market. When I said 15%, I was, of course, talking about someone looking at it in September and October. By the end of the year, as we know, the S&P was down virtually 20%. So even if you weren't in NASDAQ stocks, which was down a lot more, you were still down, almost 20% for the year if you were an average manager. It's interesting. We play this game every quarter where, corporations will sort of downplay the earnings and then they'll have a beat by a penny and everybody says, wow, didn't that company do well? They beat their earnings estimate by a penny. And I think we're going to see that. I think there's a possibility or probability even that we will see that this quarter. In other words, earnings this quarter may not be as bad as some people are fearing. And that's one of the reasons that the stock market, I think that's one of the reasons the stock market in the last sort of a short while, last couple of weeks, has not done as well, has not responded as well to the factors that have driven gold. Because other things being equal, the expectation that the Fed is going to slow and pause should be positive for the stock market as well. But I think people are concerned about earnings. So I think this quarter might not be as bad as some people are saying. We'll get a lot of companies beating expectations by a penny, and everybody will say, oh, well, that wasn't so bad. That I think will be a sort of fool's rally, if you like, because the stock market is still expensive. You're looking at almost 18 times earnings, which of course is a lot lower than we've been used to in the last 5 years or 10 years since the Fed has been printing money like a drunken sailor. But that's still well above average multiples. And the plain fact is that bear markets, I don't know a single bear market that's ever ended at 18 times earnings. A bear market tends to go down at least to the long-term average, which will be 14 or 15 times, and they normally go below that. And if you look at other indicators, whether it's price to sales, enterprise value to EBITDA, those have come down from the peaks, but they're still where we were at the beginning of 2020, which in both of those indicators were basically all-time highs. So the stock market is still trading at very, very high multiples. And I think it is very vulnerable. I mentioned this quarter's earnings, but it's very vulnerable to earnings disappointments over the next 12 months. Just before we started this, I looked to see what the latest analyst consensus estimates on the S&P is. Last year, the S&P did just over $223 per S&P share, if you like. The estimate for this year is 221 plus change. In other words, analysts' consensus estimates are that the S&P earnings will go down by less than 1% this year. I think that is wildly optimistic, wildly optimistic. And if earnings decline by even 10%, and that's very generous, I would expect in a recession to see earnings back to 180. But even if earnings decline by just 10%, and when earnings come down, your PE tends to contract. So let's again be generous and just say that the PE multiple goes to 15, long-term average. You're still or let's say even 16, which would basically be the highest of any point before the year 2000. Very generous. You're still looking at a 25% decline in the S&P. So I think we're fooling ourselves if we think we've seen the lows in the S&P for this cycle. This is an extra what we've seen in the last not the last week, but what we've seen in the last since September, October, or October, November for the S&P is an extraordinary rally, and frankly, it's an opportunity for people, to reduce their holdings, which is what I'm doing.
Now, getting back to precious metals here, if we're looking at, it seems like the last 2 or 3 months have been incredible for both gold and silver. Do you anticipate short-term a pullback here, or because I know long-term this year you're still, very bullish on metals?
Yeah, there's no question that this rally has sort of surprised me by strength, especially let's say since the middle of December. It's been extraordinarily strong, and I mean, the XAU, I don't know what it is right now, but it's up about 35-36% since the lows, whether you look at September or October, because we had a double bottom. That's an awfully strong rally. I think two things we need to realize. Gold is still very, very underowned and by investors generally, and gold stocks are still extraordinarily cheap on a long-term basis, despite the rally. So to answer your question, I think in the short term, gold is vulnerable to some kind of hawkish statement or action by the Fed, some unexpected hawkish statement by the Fed. It's interesting that in the December meeting, middle of December, when the minutes were released, the Fed, all the members were almost universally hawkish, trying to out-hawk each other. And they did that in the comments after the meeting. After the meeting, you heard different Fed spokesmen trying to outdo each other with hawkishness about how high rates should go before they paused, and so on. What's interesting to me is that when the minutes came out, gold fell quite sharply and then rebounded very sharply. That's a very strong sign that there's underlying buying. Now, in the last week, we've seen various Fed spokesmen, some expected, some maybe not expected, like Harker from Philadelphia or Bostic from Atlanta, and the Boston lady, I forget her name right now. But there's been a string of Fed presidents that have come out saying, we should have smaller rate increases now, given the CPI number. We've got inflation coming down, we're winning, and so what I'm saying is that if at the next meeting, at the end of this month, instead of 25, they say, well, let's do one more 50, that would be very devastating for gold. But it doesn't even have to be that. It could just be the comments that Jerome Powell makes after the meeting. But gold is vulnerable, I would say, to the Fed doing something unexpectedly hawkish. Again, I think that would just be short term, and that would be an opportunity to get back on.
Now, I know you've mentioned in one of your recent letters here, insights, is that the mining stocks are incredibly undervalued with respect to the physical bullion. Can you expand on that?
Yeah. If you look back, from 1971, well, let's say from 1975, after that initial run in gold, really all the way to 2007, gold and gold stocks moved pretty much in tandem. Gold stocks would move 3 to 4 times as much up or down as gold bullion, but the line is very, very constant up until 2007, and then you had this great divergence, and Gold stocks, particularly since 2011 or 12 when they peaked, have dramatically underperformed bullion, dramatically, and not just by the 3 to 4 that we're used to. There's a lot of reasons for that. One reason, of course, is the popularity of gold bullion ETFs, which make it easy for investors to buy and trade gold itself as opposed to gold stocks. Another one, of course, which we've talked about before, frankly, is just the extreme disappointment of holding gold stocks long term. You know, you look at Barrick and Newmont, and they're still meaningfully under where they were trading in the 1990s and early 2000s. But there's this gap, and the gap has just started in the last sort of 5 months to reverse. And I'm hopeful that over time, we will start to see that gap, close and go back to the historic average, the historic norm. And that's based on gold companies making money. They're making money today. They have free cash flow. They're actually got earnings, which is quite remarkable for gold mining companies. They've got a strong balance sheet. The XAU is net cash positive. Again, extraordinary when you think it's a capital-intensive industry. I don't know how long this financial discipline will last. That's a different question. But for now, the gold stocks are mostly, in aggregate, in a very, very strong position. So I expect to see outperformance of the gold stocks.
All right. Well, Adrian, we really appreciate your insights today. Before we let you go, where can our viewers find you online, and any last thoughts for your outlook for 2023?
Yeah, it's Adrian Day, AdrianDayAssetManagement.com. You can find us online. I think the thing for investors always is not to be reactive, but to be proactive. And, just as in August, September, I was pleading with people not to just give up, because every time a lot of people call me and want to go to cash, that's my clients are just a reflection of the other investors. That sentiment is at extremes, and that a turn is coming. And for now, I would say to people, don't let these good prices, both in the broad market, as well as, frankly, in the gold stocks, in some of them, don't let them just run away from you. Do some trimming, do some trimming of the portfolio, get rid of some of the laggers, make sure you lock in a few of the profits where they may be a little bit extreme. Even if gold goes to 2,000 and 2,500 this year, not every single gold stock will move up proportionately. So, don't get carried away, I guess is what I'm saying.
Fantastic. Once again, Adrian Day, thank you so much for your time today, and God bless.
Well, thank you very much, and God bless you too, Elijah. Thank you for having me.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.